What if the stock market doesn't behave like a machine, but like a living creature? What if prices don't move because of logic alone, but because of fear, greed, survival, and evolution? Adaptive markets flips everything you were taught about finance on its head. It reveals that markets don't follow fixed rules. They adapt, just like animals in the wild. Strategies are born, they grow powerful, and then they die when too many people copy them. Profits disappear not because ideas stop working, but because the environment changes. This book shows why crashes happen, why bubbles form, and why the same strategy that made you rich yesterday can destroy you tomorrow. It blends psychology, biology, and finance into one dangerous truth. The market rewards those who evolve and wipes out those who don't. If you think markets are rational, this book will challenge you. If you think emotions don't matter, this book will expose you. And if you want to survive the next financial storm, this book will teach you how to adapt before it's too late. Chapter 1. The Market is Not a Machine, from Adaptive Markets. Chapter 1 destroys the traditional idea that markets are perfectly rational and predictable. For decades, finance believed in one powerful assumption, that investors behave logically and prices always reflect true value. But this chapter argues something radical. Markets behave more like ecosystems than machines. They evolve, adapt, and react to their environment just like living organisms. The author introduces the idea that human behavior is driven by survival instincts, not cold mathematics. Fear, greed, competition, and imitation shape prices far more than spreadsheets do. When conditions are calm, markets look efficient and stable. But when stress appears, wars, recessions, pandemics, or crashes, emotions take over and logic collapses. This explains why bubbles inflate and why panics spread like wildfires. Chapter 1 also explains why financial strategies rise and fall over time. A strategy works not because it is true forever, but because it fits the current environment. Once too many investors copy it, profits disappear. Just like in nature, successful traits spread until resources run out. The market rewards adaptation, not perfection. Most importantly, this chapter introduces the core philosophy of the book markets are shaped by competition. Investors learn from experience. Profits come from adapting faster than others. Instead of asking, is this strategy correct? The chapter teaches you to ask, will this strategy survive in today's market climate? This chapter reframes finance as a battle for survival. Those who cling to old models get wiped out. Those who evolve with changing conditions stay alive. The market is not a calculator. It is a jungle, and only the adaptive survive. Chapter 2. From Efficient Markets to Adaptive Markets. Chapter 2 explains why the old financial theory that markets are always rational and efficient is incomplete. Traditional models assume investors are calm, logical, and unemotional. But real humans are nothing like that. This chapter shows that people make decisions using habits, instincts, and shortcuts learned from experience. We don't calculate perfectly. We react, especially under pressure. The chapter introduces the bridge between two worlds, classic finance and behavioral psychology. It explains that mistakes in markets are not random. They are patterns of human behavior repeating again and again, overconfidence in booms, fear in crashes, and blind imitation when uncertainty rises. These behaviors once helped humans survive in dangerous environments, but in financial markets, they create bubbles, manias, and sudden collapses. Next, The chapter explains how learning changes markets over time. When a strategy works, investors copy it. When it fails, they abandon it. Over many cycles, the market learns what works and what doesn't, just like species evolving through natural selection. This is why no strategy lasts forever. Profits shrink as competition increases, and only new ideas or better risk management can restore an edge. The key message of Chapter 2 is that market efficiency is not a permanent state. It is temporary. Sometimes markets are calm and logical. Sometimes they are chaotic and emotional. Sometimes they reward discipline. Sometimes they punish it. Instead of believing in one eternal rule, the chapter teaches a new mindset. Markets adapt to investor behavior. Investor behavior adapts to market outcomes. Survival depends on flexibility, not prediction. By the end of this chapter, finance is no longer about finding perfect formulas. It becomes a study of human nature under competition. The smartest investors are not those who assume stability, but those who prepare for change. Chapter 3, Survival of the Richest. Chapter 3 connects financial success directly to evolution and natural selection. It explains that wealth in markets is not distributed by fairness or intelligence alone. It is shaped by competition. Just like in nature, those who adapt best to their environment accumulate more resources, while those who fail to adjust are slowly eliminated. The chapter shows that financial markets are ecosystems where different species of investors compete. Traders, long-term investors, hedge funds, institutions, and speculators. Each group uses different strategies to survive. When one strategy dominates, it attracts more capital. But as more players copy it, the advantage disappears. Over time, profits migrate from the slow and rigid to the fast and flexible. This chapter also explains why inequality naturally emerges in markets. Those who adapt early gain more capital, which gives them more power, better tools, and greater survival odds in future cycles. Success feeds on itself. Failure does too. This creates a financial food chain where weak strategies die out and strong ones reproduce through imitation. Another key idea is that risk-taking is not just about courage, it is about survival pressure. When competition increases, investors are forced to take bigger risks to stay alive. This is why booms encourage bold behavior and crashes punish it brutally. The environment decides what level of risk is rewarded at any given time. The core lesson of Chapter 3 is simple but ruthless. Markets don't care who you are. Markets reward adaptation, not effort. Wealth flows to strategies that fit the environment. In this chapter, investing stops being a game of numbers and becomes a battle of evolution. The winners are not the smartest. They are the ones who change fastest when conditions change. Chapter 4, Fear, Greed, and the Brain. Chapter 4 dives into the human brain and explains why markets move the way they do. It shows that financial decisions are not made by pure logic. They are driven by ancient survival systems inside the brain. Long before stock markets existed, humans evolved to react quickly to danger and opportunity. Those same instincts now control how we buy, sell, panic, and chase profits. The chapter explains that fear and greed are not flaws. They are biological tools. Fear protects us from loss, and greed pushes us to seek reward. In calm markets, the rational part of the brain can think clearly and plan ahead. But when prices crash or skyrocket, emotional systems take control. This is why people sell at the bottom and buy at the top. The brain is wired to avoid pain more than to seek logic. It also shows how repeated experiences rewire behavior. When investors make money using a strategy, their brains reward them with confidence and habit. They repeat the same behavior again and again, even when conditions change. This is how bubbles form. Success creates belief. Belief creates imitation, and imitation inflates prices beyond reality. Another powerful idea in this chapter is that stress changes decision-making. Under pressure, people stop calculating and start reacting. They follow crowds, copy headlines, and rely on instinct. This turns markets into emotional stampedes instead of rational systems. The main lesson of Chapter 4 is clear. Markets are shaped by human psychology. Psychology is shaped by survival instincts. Survival instincts are not designed for modern finance. To survive financially, the investor must understand their own brain, not just charts and data, but fear, habit, and impulse. The real enemy is not the market. It is the emotional machine inside your head. Chapter 5. When markets go mad, Chapter 5 explains why financial crises, bubbles, and crashes are not accidents. They are natural outcomes of human behavior under stress. The chapter shows that when markets change too quickly, the brain's survival systems take over. Logic weakens. Emotion rules. This is when markets go mad. The chapter describes how success creates overconfidence. When prices rise for a long time, investors start believing the good times will never end. Risk feels invisible. People borrow more, invest more, and ignore warning signs. Strategies that worked in the past are pushed harder and harder, even when conditions are no longer safe. This is how bubbles grow, not from stupidity, but from learning the wrong lesson from success. When the environment suddenly shifts, panic replaces greed. The same crowd that rushed in now rushes out. Fear spread faster than facts. Selling becomes contagious. Prices collapse not because value disappeared overnight, but because survival instincts demand escape at any cost. Markets don't fall calmly, they fall violently, just like animals fleeing danger. This chapter also explains why regulation and rules often fail to prevent crises. You can't eliminate fear and greed with laws. You can only slow them down. Since markets are adaptive systems, they always find new ways to create risk. When one danger is blocked, another appears somewhere else. The core lesson of Chapter 5 is brutal, but honest. Crashes are part of the market's evolution. Stability creates risk. Calm periods plant the seeds of chaos. This chapter teaches that the goal is not to avoid every crisis. That is impossible. The goal is to recognize when behavior is becoming dangerous and when the environment is changing. Survival belongs to those who see madness forming before it explodes. Chapter 6. Learning, Memory, and Market Behavior. Chapter 6 explains that markets have memory, not in computers, but in people. Every boom and crash leaves scars on investor behavior. What traders experience today changes how they react tomorrow. Just like animals remember where danger lives, investors remember where pain and profit came from. The chapter shows that learning in markets is not instant or perfect. People learn through trial and error. When a strategy works, it feels safe and smart. When it fails, it feels dangerous and stupid. Over time, this creates habits. Entire generations of investors grow cautious or reckless, depending on what they live through. Those who experienced crashes become defensive. Those who only saw rising markets become bold. This creates cycles of behavior. Long periods of stability make investors forget risk. They trust models, formulas, and past success too much. But once a crisis hits, memory returns. Fear becomes stronger than logic. The market swings from confidence to caution, from risk-taking to survival mode. These emotional waves shape prices just as much as earnings and data do. Chapter 6 also explains why new strategies keep appearing. As investors learn, they adjust. When one method stops working, another replaces it. This constant experimentation is how markets evolve. Some ideas survive. Most die. The market becomes a testing ground where only strategies that fit the environment stay alive. The main lesson of Chapter 6 is powerful. Markets remember through human experience. Human experience changes future decisions. This creates repeating cycles of boom and fear. In this chapter, finance becomes a story of learning under pressure. Not cold logic, but emotional memory. Not perfect prediction, but painful adaptation. The investor who survives is the one who respects history and understands how memory shapes behavior. Chapter 7. Risk is not a number, it's a feeling. Chapter 7 challenges the idea that risk can be captured perfectly by formulas and statistics. Traditional finance treats risk as a mathematical value. Volatility, variance, probability. But this chapter argues something deeper. Risk is experienced emotionally before it is measured mathematically. People don't react to risk based on numbers alone. They react based on fear, confidence, and past pain. The chapter explains that when markets are calm, risk feels small, even if it is actually large. Investors become comfortable, leverage increases, and caution disappears. Models say everything is safe because recent data shows little danger. But this is an illusion created by stability. The absence of disaster makes people forget disaster is possible. This is how hidden risk builds silently under the surface. When conditions suddenly change, perception flips. The same positions that felt safe now feel deadly. Risk explodes emotionally before it explodes financially. Investors rush to reduce exposure not because models changed, but because survival instincts woke up. This is why markets move faster than statistics can explain. Emotion updates quicker than equations. Chapter 7 also shows that different investors feel risk differently. A young trader, a pension fund, and a hedge fund all see the same market, but experience different danger levels. Their goals, time horizons, and past experiences shape how much uncertainty they can tolerate. This is why there is no single correct measure of risk for everyone. The core lesson of Chapter 7 is critical. Risk is not fixed. Risk depends on environment and psychology. Risk is underestimated in good times and exaggerated in bad times. This chapter teaches that managing risk is not just about controlling numbers. It is about controlling behavior. The investor who survives is not the one with the best model, but the one who understands when confidence is becoming blindness and when fear is becoming panic. Chapter 8. Innovation, Competition, and the Death of Strategies. Chapter 8 shows how financial innovation constantly reshapes the market environment. New tools, new data, and new strategies don't just improve investing, they change the rules of survival. When technology advances or new ideas spread, old methods stop working. What once produced easy profits becomes crowded and weak. The chapter explains that competition kills strategies. When a profitable idea is discovered, it attracts attention. More investors adopt it. Capital floods in. Returns shrink. Eventually, the strategy no longer works because too many people are using it. This is not failure. It is evolution. The environment adapted to the strategy, and the strategy lost its edge. Innovation speeds this process up. Faster computers, better algorithms, and global communication mean ideas spread instantly. There is less time for any advantage to survive. Profits become temporary rewards for creativity, not permanent income for tradition. The market becomes a battlefield of constant experimentation. Chapter 8 also explains why financial history is filled with once great methods that eventually collapsed. They didn't fail because they were wrong. They failed because the world changed. Regulations shift, technology improves, investor behavior evolves. Each change rewrites what works. The core lesson of Chapter 8 is sharp-nosed strategy is immortal. Profit attracts competition. Adaptation is the only defense. This chapter teaches that the market is not something to solve once. It is something to continuously relearn. The winners are not those who find one perfect method, but those who reinvent themselves when the environment changes. Chapter 9. Why Regulation Can't Stop Human Nature. Chapter 9 explains the limits of rules, laws, and financial regulations. The chapter does not argue that regulation is useless, but it shows why regulation alone can never make markets perfectly safe. That's because regulation tries to control behavior with rules, while markets evolve by finding new paths around those rules. The chapter describes how every major financial crisis leads to new regulations. Each crisis creates a belief that this time the system will be fixed. But as soon as new rules are introduced, financial innovation begins adapting to them. New products, new loopholes, and new risks appear. The danger doesn't disappear. It simply moves to another part of the system. This chapter also explains that risk-taking is deeply human. You can restrict certain actions, but you cannot remove the desire for profit, status, and advantage. Investors will always search for higher returns, and institutions will always search for ways to compete. When one road is closed, another is built. Another important idea is that regulation often assumes stable behavior, but markets are unstable by nature. Rules are written for yesterday's problems, while new risks are born tomorrow. This time gap is why regulation often arrives too late. The main lesson of Chapter 9 is realistic and sober. Regulation can reduce damage, but not eliminate it. Markets adapt faster than laws. Human nature outpaces human control. This chapter reframes crises as evolutionary events. Each collapse teaches the system something new. Each reform reshapes behavior. But the cycle never ends, because adaptation never ends. Chapter 10. Building a Smarter Financial System. Chapter 10 shifts from explaining problems to exploring solutions. It asks a powerful question. If markets are adaptive and driven by human behavior, how can we design a system that survives instead of collapses? The answer is not in creating perfect rules, but in building systems that expect mistakes, stress, and change. The chapter explains that traditional finance tries to create stability by assuming rational behavior. But since humans are emotional and markets evolve, the system must be flexible, not rigid. Instead of pretending crises won't happen, smart design prepares for them. This means encouraging transparency, controlling extreme risk-taking, and creating buffers that absorb shocks rather than amplify them. Another major idea is that diversity increases survival. When everyone follows the same strategy, the system becomes fragile. If one method fails, everything fails together. But when investors use different approaches, time horizons, and risk styles, losses are spread out. Just like in nature, ecosystems with more diversity survive disasters better than ecosystems built on one species. Chapter 10 also emphasizes learning as a permanent feature of finance. Data, psychology, and technology should work together, not separately. Policymakers, institutions, and investors must study past crises the way scientists study natural disasters, not to eliminate them completely, but to reduce their impact next time. The core message of Chapter 10 is hopeful but realistic. Crises cannot be erased, but damage can be reduced. Adaptation can be guided, not stopped. It is not about building a perfect market. It is about building a resilient one, a system that bends instead of breaks, learns instead of repeats, and survives instead of collapses. Chapter 11, Investing as an Evolutionary Game. Chapter 11 reframes investing as an evolutionary game instead of a math puzzle. It explains that success in markets depends less on finding a perfect formula and more on understanding who you are competing against and how the environment is changing. Every investor is part of a competitive ecosystem where strategies rise and fall based on how well they fit current conditions. The chapter shows that different market environments reward different behaviors.